Hey there, traders and investors. Todd Gordon, founder of Inside Edge Capital. It is the 3rd of April, 2025. Huge historic down day in the markets. This video is going to be quick and fairly concise, but I wanted to speak directly to the investors at Inside Edge and kind of update you as to what we did today, the way we're seeing things, give you a couple business updates and see if we can shed some light on the madness that we're seeing right now. So I put a little presentation together. I'm flying solo tonight. Kyle is not here, but let's hit it. So without further ado, Investors Edge, April 3rd, 2025. Disclosures, be sure to check that out. Okay, so economic market update Q1 of 25. Here's what we're going to cover tonight. And again, this is going to be more less formal, to the point. A lot of people are, obviously very upset and emotional as to what's happening in the market, and I'm just going to get right down to it. Okay. Before we do that, and again, I'm speaking to clients of Inside Edge Business Update. Two things. We have a new website that our designers and programmers say should be out by the end of this week, and it's already Thursday, so we'll see. So brand new website that include a members area where these kind of communications will be with password protection for members and investors only at Inside Edge. So this kind of stuff going forward will be password protected. And plus we have a cool new website we put a bunch into. Active Ops is also happening. This is, and I will describe that in just a little bit, but it's a new portfolio that is really useful in times like this. It's our speedboat portfolio, holding very high growth, high earning stocks with good fundamentals and technicals in up markets, and then hedging and net shorts in down markets and bear markets. So that is now live. We'll talk about that. Market volatility, tariff tantrums. Trump just put out a headline, open negotiation. We're going to look at the market internals, technicals, trade balance. We're going to look at credit spreads, and we did some updates at the close today. We'll talk all about the market, but we did eliminate and cut back some of our exposure. We cut the SPY and the Qs. Those were placeholders from November when we put some hedges in. We had some inverse SPY and inverse QQQ hedges in. I was a little early on those. I took them off. I put the SPY and QQQ back on as placeholders. We took them off. And today we also caught Google, Manhattan Associates, MANH, A-Lab, Trade Desk, TTD, and ESI. So we did scale back some exposure today. We'll talk about the specifics of the market. We are going to put that in short-term Treasury ETFs to earn a yield, but we did want to scale back on some of the exposure for now with so much uncertainty. Okay. So as I mentioned, just a real quick look here. New website, just a screenshot. It'll be a different video right here. And then, as I mentioned, active opportunities is open. It's considered our tactical active ops. Act as a speedboat, so to speak, will be aggressive bull markets holding the strongest fundamental technical names. They're growing earnings, raising guidance, leading their respective industries. And also, times like now, we'll have net short exposure, option hedges. It's something that we recommend no more than 10 or 15% of your overall portfolio allocated here, because again, this is meant to add alpha in bull markets and act as a hedge and net short exposure in down markets. So it'll be active. It won't have tax as a consideration. We can and will take short-term gains, so keep in mind that it will not be tax sensitive. Okay, so if you have questions about that, you can reach out to us. Okay, that's that. All right, so to business. Tariffs. Just at the close here, after he unveiled, 10% across the board, April 4th tariffs, April 5th, I should say, and then reciprocal tariffs on April 9th, just came out and said he's open to tariff negotiations. And the tariffs were so shocking and so large, upwards of 46% to China. They're so astronomical. I think, I saw this quote that I guess to be, I don't even know how to say it, but you gotta let the party you're negotiating against think you're crazy enough to go through with, such an unbelievable threat. And he might just be crazy enough to go through with it, enough so that the people that were negotiating, the countries that were negotiating against, are going to come to the table, and ultimately that's his goal. I think they're so egregious, I should say, that and again, did people think he's obviously not running for another term? Is he crazy enough to go through with it and bring different countries to the negotiating table? That seems to be the game right out of Art of the Deal, in the book that no doubt is going to be sold out on Amazon here, trying to unpack the mind here. So according to Market Watch, tariffs are estimated to generate as much as $500 billion a year or $5 trillion in a decade, according to Trump advisor. The budget lab at Yale, this is from Market Watch, says a more reasonable estimate is $3.1 trillion if the level of imports don't fail because of the escalated cost. So the question is, and probably what he's doing is he's trying to shock the market now with the tariffs, trying to level the playing field for trade, also at the same time push the Fed to drop rates. And I criticized Trump for the last time in 16 and 17, he campaigned on lower rates, and when he came in, he was threatening Powell with his life and job if he didn't cut rates, and he looked foolish, I think, doing that, especially as he campaigned on the outlook for lower rates. And now I think he's being trying to be more tactical with it, by forcing a slowdown in the short term in the economy to get Powell to drop rates. And we'll talk about the likelihood. I think it's about 95% chance of a June cut. But, he's being tactical, but he's also taking a sledgehammer to global trade at the same time. So I have my doubts. I was generally supportive of his policies coming in, but I have my doubts that this is gonna wind up successful. I don't want to panic. That's going to be one of the themes that we're going to talk about tonight, is to not panic when markets are fearful. That is the wrong thing to do, but I'm very vigilant as to what is happening here. Okay, now I have to think that I need goodness gracious. I mean, I'm not asking for any sympathy or whatever, but I look like hell. I need a haircut. I've been up at 3:30, 4 o'clock every day, going through, just trying to get set before the markets catch up and everything that's going on. It's been a week. Again, I'm not. This is my chosen and beloved profession, so it's been quite a week. I'll get a haircut. So, but I can't help but think he's shocking the volatility, trying to bring trade partners to the table, trying to get the Fed to drop rates, and then I think he's setting the stage for the 2017 tax cut to remain permanent, but then additional tax cuts. Tax cuts will be made up from revenue from the tariffs. That's the theory. And if you can thread that needle, I do think a pretty significant boom is coming, and he's countering what Navarro. I was listening to Navarro's interview on CNBC, and he said tariffs are not a negotiation. They're not. And he was very matter of fact, but then Trump came out and said he's open to tariff. He's looking to see who's going to come to the table first. And the quicker the countries come to the table to negotiate, the better deal he's going to get. So everything's negotiable with him. And the communication has been horrible, and I think it's so bad that that's part of the art of the deal. He's going to be quiet on this and let us all stew until April 9th, when these reciprocal tariffs go on. And then we're going to get more color. And the reason I took SPYs, Qs, I took Google off. I don't like Google anymore. And the other positions I wanted to cut anyways, I think we're in limbo for a week, and I'm afraid of what might happen in the market between now and then. But everything's open for negotiation. He is not going to let this thing fall apart. He's absolutely not. He's got a target on his back, literally and figuratively anyway. So, I mean, he's not going to let this thing get too far out of control. And, and it's really, this whole sell-off is not market technical or anything like that. It's just pure economic policy. So I started to get into this. I'm like, let's figure out the extent of the imbalance in the trade balance. And looking at St. Louis Fed, I don't know what the takeaway is on this. And everyone is, no one knows. No one knows, understands the formula that they use. Like, it's, where does this math come from? There's a lot of, in the emptiness of the explanation, people's theories are running wild. And, I don't have an opinion yet, and I need to continue to read on this and learn more. But here's what I found from St. Louis Fed. And I'm just going to kind of read this article. And if you click this link right here, it'll take you right to it if you have the PDF. So this is the trade balance, goods balance of payments, shows the U.S. trade balance. Looks like things are seriously heading south with a deficit that's 10 times larger than it was 25 years ago. So it was a $20 billion deficit. Now it's 100 and whatever that is, 50 something billion trade deficit, right? But you got to put it as a percent of GDP. Okay, you got to compare to GDP. 10 times larger than it was 25 years ago. Is it that bad? For one thing, the economy as a whole has grown significantly over this period and prices have increased. To address this bias, we should divide the trade balance by our favorite nominal index, nominal GDP. The result is the graph below. Now, the other thing I'm thinking is, why nominal? Why wouldn't they factor in real GDP with inflation? That's something, again, it just occurred to me, like, why wouldn't they do real GDP? Nominal yields are one thing, but you got to factor in inflation. So let's put an asterisk on that, and I need to investigate it more. But as you put it as a percent of nominal GDP, these are percentage points here. We got down to like 6.5% of nominal GDP right about here at about 80 billion trade deficit. We rallied up in COVID. And they're making the point here that we're about 5% of GDP. So GDP is 27 trillion, and our trade balance is 150 something billion. Okay, so it's a couple percent, 4 or 5% of GDP. Now that the units are percentages of GDP, which is 4.5% of GDP, we can see the deficit is 5 times as large as it was 25 years ago, not 10 times, and has actually improved since the previous recession to a little more than 3 times its size, topping out at minus 4% of GDP. But wait, there's more. International trade doesn't pertain to goods alone, it pertains to services. And here, U.S. enjoys a surplus. So if you redo the second graph with the trade balance for goods and services, you obtain the graph below, which is about 3.5% of GDP is our trade imbalance. So finally, you see the current trade deficit about 3% of GDP. Is it a lot? Actually, deficit isn't necessarily bad. See a previous blog, and I read this, and there wasn't too much helpful to it. And they're like, basically, if you have a very well-off, rich economy, why wouldn't we pay more for goods and services overseas that are produced at a lesser cost? Now, this made sense to me, and I came in with one preconceived notion that, perhaps we need to right a terrible wrong of trade imbalance. And put in those terms, it makes a little bit more sense, like why there's so much pushback on this. However, I find it a little suspect that you're doing as a percent of nominal GDP, not real GDP, with factoring inflation. I think those numbers will be higher, but is a 4%, including goods and services, deficit as a percent of GDP, is that us being ripped off? And that's the question on the table. And I think that's what markets are trying to struggle with. So I'm still trying to wrap my mind around this. Let's look at the technicals of the market here. High yield junk bonds. Okay, so what we're doing here is you're looking at the yield on double B or less investment, less than investment grade bonds. Okay, now as that yield goes up, On the investment grades, that means the price of junk bonds, let's call them less than investment grade BB bonds, as those bonds are being sold off in risk averse periods, the corresponding yield goes up. And the higher that yield goes relative to the U.S. Treasury yield, a basket of U.S. Treasury securities, the higher that spread, the greater the yield spread, which indicates, if yields are being sold on junk bonds, yields are going up, junk bonds are being sold off to a greater extent than U.S. Treasuries being sold off, and their corresponding yield goes up. Widening credit spreads indicate risk aversion, volatility, and fear in the market. So our credit spreads widening out. And it's very common knowledge, and there's plenty of precedent over the entirety of our system, that the bond market is much smarter than the equity market. And is the fixed income, the bond market, showing the stress that the stock market is? The answer I'm going to show you is no. So here's the full explanation of this ICE Bank of America option adjusted spreads, calculated spreads between a computed OAS index of bonds, blah, 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 blah. These bonds are below investment grade, rated BB or below, tracks performance, blah, blah, blah. Okay, so you could see in blue, that's the yield spreads. Again, junk bond spreads compared to U.S. Treasury yields. And as they spike, that corresponds to recession. So there's COVID right there, and you can see the blue spike. There's 2007, 8, and 9, global financial crisis, and there's the tech sell-off. Credit spreads spiked massively as the S&P in red sold off. This is actually the NASDAQ. NASDAQ sold off, credit spreads spike. NASDAQ sells off in 2008, global financial crisis, credit spreads spike. COVID, we are nowhere near the credit spread point that would signal even fear or a coming recession. Long ways to go on that. Okay, inflation expectations. Now, I also hear a lot of reports that are they're so-called soft reports that are surveying people's thoughts, feelings, and emotions. And I saw a lot of headlines saying consumer inflation expectations reach 30-year high. Business confidence, CFOs, confidence survey. Like, the softer emotional side of people are really hurting, and it's showing up in reports, and it's making headlines, further driving the fear. Here's a perfect example out of Bloomberg. U.S. consumer inflation expectations spiked to 30-year high. The view is that tariffs are going to be widely inflationary, combined with contraction of our economy and global economy, combined with price inflationary tariffs. That's what they call stagflation, which is inflation, lingering pesky inflation with no growth. And that's the big fear right now, is tariffs are going to contract growth and spike inflation, which leaves us in a stagflationary economy. Well, you look at the headline and you're like, okay, consumers said they expect prices to climb at an annual rate of 3.5% over the next 5 to 10 years, according to the University of Michigan survey. The rate is the highest since 1995. So that's really getting 32 something, I guess that would be 30 something years. And more than all 5 components of the index deteriorate, including a drop in buying conditions for big ticket items, and more than half of consumers surveyed expect the unemployment rate to rise over the next year, the highest since 2020. This is emotional. Consumers, investors, humans are just emotional. This is the expectation. U.S. long-term inflation views jumped to nearly 30-year high. Interestingly enough, and this is from Bloomberg, perhaps a sign of how America's furious polarization may in part tinge economic attitudes, the spike was almost entirely driven by views among survey respondents who identify as Democrats. Guys, Trump is so polarizing. The mix of political leanings and biases is overlapping so much in portfolio management and the fundamental assessment of this economy. I'm only 46 years old. I've been, trading professionally since I was 21. So, I'm a good halfway through my career. I'm still learning so much. I've never seen such a polarizing political environment that is impeded in the economy. It's amazing how emotionally driven people are right now who hate Trump, and they're making these very, very big decisions with their portfolios, which really shouldn't be crossing in as much. So if you look at the 5-year break-even inflation expectation, this was updated April 3rd, which is today at 4 p.m. Central. Inflation expectations are 2.5%. And if you look at where we've been since here's 22, that the height of the inflation spike when rates were spiking and we're dealing with post-COVID fiscal and monetary policies that spiked rates, and inflation expectations 3.5%, we're at 2.5%. The Fed's long-term inflation goal is 2%. So we're 50 basis points above. We came up from July of this year. We went from about 2, right where the target is, to 2.5. So we're 50 basis points high. Are we at this point where Trump tariffs are going to spike inflation expectations? The soft surveys over here on the left by the emotional masses say yes. The real data in terms of money being put to work in interest rate markets say no. We're not anywhere near a fever spike. So on top of that, if we really were going into a stagflationary slowdown, which means persistent inflation driven by tariffs combined with decreased GDP and economic growth, the Fed wouldn't be able to cut rates. And this right here says in the June meeting, we're at a 94% chance of the Fed cutting. And I'll tell you, this 32% chance of a cut in May was not there last week. And we're starting to price in a 1/3 chance of a cut in May to steady the threat in economic growth. And if the persistent inflation worry was there, Fed fund futures wouldn't be pricing in interest rate cuts because you can't cut if inflation is re-engaging. And as I showed you in the last chart, it's not there. People think it's going to be there, but the money is not flowing into markets that say it's going to spike. So, we have one rate cut scheduled for June, another one for July. Looks like they're going to try to take September off, maybe October and December. So you're counting 1, 2, 3, 4 cuts in 2025 is where the market is currently pricing. Okay, so these charts are right off the press. This is the 2-year Treasury yield, which very closely reflects where Fed fund futures go. Fed fund futures is very short-term Fed, 30, 60, 90-day, Treasury bills, real short-term. 2 years do track it pretty closely. 2 years spiked down to 3.7%. Current Fed funds right now range is 4.25, 4.5. So 2-year Treasuries right now are pricing in 50 basis points, actually more than 50 basis points of cut, which gives you the June cut and the July cut. So, markets are pricing the Fed's going to cut rates. And I think that's what Trump is really trying to do, trying to be more tactical than 16 and 17. But he's doing it with a very blunt instrument, threatening to dismantle global trade, which I don't agree with. So there's the 2-year yield. Here's the 10-year yield. So 10-year yield's about 4.05. The 2-year yield is 3.7. You want the longer-term yields higher than shorter-term yields, and that is the so-called yield spread. And when short-term yields, the 2s, are above the 10s, like 23, that's when you had yield curve inversion. Below this yellow line is, on this scale, is yield curve inversion signaling coming recession. What's happened in 23, 24, and 25, the 10-2 spread has gone from negative 100 basis points to negative 50 to 0. We're hanging at 30, 35 basis points of normalization in the yield curve. Yet another example that real money, not emotional, soft reports are saying that recession is not coming. Okay, because we have the yield curve continuing to move higher. And you could even argue there's a moderate correlation with the S&P in red and the 10-2 curve, which the 10-2 curve has stayed pretty firm. The S&P sold off, as we know. But, since 22, I would say there's a moderate relationship between the two. So if the 10-2 curve continues to go, if this relationship is accurate, maybe the S&P is oversold. This is going to get a little technical, but what we're looking at here is this is the MSCI US stock market ETF divided into the MSCI All World Stock ETF minus the US. So it's the US ETF divided into all world stock market without the US. Okay, and with this line going up, that means the US ETF is outperforming the all world ETF ex-US. So what's happened is, we've had a rotation out of the US ETF into the all-world ex-US ETF. Only to this extent, I would submit to you, since the global financial crisis, the US is clearly in an uptrend relative to equities around the world. China, Europe, Latin America, et cetera, et cetera. Have we seen a small rotation? Yeah. We have a long ways to go. I would say down into about the 1.95 ratio. Again, I can give you the symbols if you're interested in, but we have a long ways to go until you tell me there's a clear rotation out of US into international markets. Okay, and I would say there's a technical support level channel that is still very much intact. So way too early to say there's a rotation heading into Europe, which, European markets have done better, but it's multiple expansion. It's not increased earnings in Europe. It's just money rotating in, bidding up the price of European markets while earnings expectations stay flat. So that's what they call multiple expansion. Volatility index. Let's bring it back to the U.S. How fearful did we get? We got a 30 VIX. Higher the VIX, the more fear, the more bids go into option markets for protection. We couldn't really get. Where was the summer? Where was the summer? This was 22. The summer must have been right. No, I'm an idiot. 24 summer. Okay, yeah, that was a summer spike right there. Okay. So, anyways, we could not get above the 22 sell-off right here. Okay, so this is the 2022 sell-off. We are nowhere near the VIX spike compared to that. And then this is COVID right here. Okay, this is the COVID. Here's the COVID spike. No, this is not right. Hold on, this is not right. I know give me one sec. This doesn't look right. Audible. Oh, that's why. Okay, here we go. I'm like, what's going on here? Here's the actual chart. I still have it up. It was a closed chart. It wasn't a line only chart. Okay. So what's going on here? Here's the VIX. Let me get this straight. This was the summer spike right here. Okay, that was August 2024. I was on vacation. I came rushing home. This was the August sell-off where the yen carry trade sold off and U.S. yields dropped very sharply as the bond market was trying to force the Fed to cut. The VIX on an intraday basis went up to 65. Okay, here's the VIX today. We got up to 30. Okay, we barely made it above the March 11th high right here. Okay, so yeah, the S&P is at a new low, but the VIX barely made it above the equivalent March low, and is nowhere near what we saw back in the summer of 24. All right, so let me go from a daily to a weekly. Let's see what else we have here in the VIX. I mean, here's the 22 sell-off with rate spike and inflation raging. Look at the persistent 30, 35, 38 VIX spikes. We couldn't even get to 30 today, and today was a washout in the equity market, a pure washout. So the volatility is not as it was a very orderly selling. There was not a lot of institutional sell programs out there. I'm not trying to be rosy bullish here. I'm trying to remain objective. And this is a time where when people get really fearful, that's when you have to step back and say, okay, let's consider everything that's going on here. I trimmed exposure. And I hate even doing that because this is the kind of market where we could come back and the market's up 7% tomorrow. And if you miss out on that 7%, it changes your return profile for the whole year. So but I am aware that we could go lower. Okay, so let's keep going on this. And I'm going to show you where I think the market might go. Okay, here we go. So that answers that VIX question. Okay, to the technicals real quick. S&P is facing support zone right here. 54.20 in the S&P down to 53.40. This is the decision zone. These are some of the gory technicals behind the scenes that I do over at Trading Analysis, which, I just want to remind the inside edge investors that I speak every single day to the Trading Analysis people. I'm waiting for the Inside Edge site to be built, which should be done this week, and then we'll be able to launch hopefully in the next week, where we're going to have weekly meetings with all Inside Edge investors. So I hate leaving you in the dark right now. I'm just waiting for this website to get done. It's taking so much longer than I want. Okay, so I just wanted to remind you that. So the S&P, I think we're in a 54.40, 53.40. This is a key decision zone that we've been covering every single day for the short-term people. If it breaks, we're going to get more defensive. And if we don't hold the 5,400 level, the probability of a retest of the 21, 22 highs in the S&P at 48.18 is pretty real. We've already come off 12% in the S&P. The retest of these significant pre-inflation interest rate spike highs in the S&P is another 10.5% down. If we don't hold this zone right here, probably heading at least down to that zone, and I will get more protective with the portfolios, okay? Now, let's just consider everything. How bad is this in the S&P? Yeah, the NASDAQ, oh my God, my hair, whatever. The NASDAQ is sold off more. It's about 17, 18%. But we have to consider how far the market has come. The market from the 22 lows, the S&P has rallied 76%. We've given back 12. Okay, context really matters. We're up 76% since 2022 in the S&P, and the NASDAQ's more. And we're off 12% right now. Just square that up with the roaring pitch, the feverish roar, just the unbelievable emotion that was driven through the markets today. We're off 12% from the all-time highs of the S&P. Okay, the 2022 inflation and rate spike dropped the market 27%. Okay, so and even if you look and you go back to like the COVID lows, like we're up hundreds of percent. So, context matters in this. So I think, it's really a good time to deep breath. I hate giving back 12% in the S&P, 15, 17%, but we're also enjoying, those of you who've been with us for a while, you're also enjoying a lot of gains. We're nibbling, we're managing at the margin. Active Ops is coming online. We'll be deploying option hedges. If it looks like that support zone in the S&P is going to give way, and that's a nice way to hedge, I will also be adjusting the portfolios in TAG and SIG, and just kind of taking it day by day, stepping back and seeing what comes out of the White House next and how everyone reacts. So I just wanted to touch base with you real quick. 34 minutes is not that quick. Hope that helps, guys. Let us know if you have any questions. You know how to reach us. You have both Kyle and my cell phone and our emails. So we'll leave it there. Talk to you guys really soon. Thanks.